Greetings, everybody. This is Jeff Scott, and this is my top-down review for December 12th, 2021. I guess it's about that time. Yeah, it's just after midnight, Saturday going into Sunday. I'm on the road, so that means a couple of things. It means the resolution will not be 4K. It'll be closer to 3K. And if the sound sucks, it's because I don't bring my microphone with. It was a great week. I made money. Hopefully you made money, although still, some of the high-priced stocks continue to sell off. And I asked the question, does a good beginning and a nice end to the week and strong seasonality suggest that maybe a year-end rally is upon us? We'll take a look at the evidence and let's get started. For those that are new, I've done this probably for close to 20 years. I post them in YouTube. In the beginning, it was more monthly, every other week, and now I seem to do this weekly. I'm independent. I don't charge for any services at this point. And I can be reached at hgsidoc@gmail.com. Yeah, I watched a wonderful video that Ron Brown did this weekend. And, Ron and I are both strong proponents of HGSI. He brought the VSA tools in, and it's still very impressive what he can do and how you can avoid spending a lot of money on some of the programs that people sell for value spread analysis. He made comment about all you need is Thinkorswim and HGSI, and I don't disagree. I think for the most part, you can do most of your trading there. I elect to use some other platforms, and that's just because how I like to do it. And, frankly, I can afford to buy them, which I'm sure Ron could too if he wanted to. And I think each of us has to pick what they want to do. But I think HGSI, and I would agree with Ron, that plus Thinkorswim is enough for the vast majority of trading. This is for education purposes only. Anything I recommend is in the spirit of education, not investment advice. I am a doctor, not a broker. I am independent. I'm not affiliated with any software vendor or trading company. I've paid for the tools that I use. And trading involves risk, and you are solely responsible for any investment decisions you make. I'm not going to spend much time here, but these are some of the people that I've learned from. I've built my own brand. I like to call my brand Be Your Own Guru. And by that, I mean learn from smart people, find what works for you, and build your own platform, build your own style of trading, your own approach to money management, and learn, perfect, and make money doing it your way. I own a lot of software, and I'll use TradeStation and Thinkorswim. Increasingly, I'm using wealth charts. Hgsi and EdgeRater are critical parts. You'll see them in this PowerPoint. And then within TradeStation and Thinkorswim and other programs, I use a lot of indicators. That's Dr. K's tools, Q tools, and most importantly, John Person's set. I will bring people from time to time to meet with you during this vehicle, webinars, etc. And I never take a penny on your purchases. I just want you to get exposure to the things that I use. I've decided not to do a stock club this month. I've been swamped, and we'll resume in January. And the other thing to point out in January, the Wealth 365 event. I think Wealth Charts is a wonderful platform. I think it, in some ways, could be a replacement for TradeStation. They have a lot of educator created indicators and scanners. And I just suggest maybe you take a look at it during that event. The reason why, because it's when it's the least expensive of the year. HGSI, this is the website, free 30-day trial. And under investing strategies, you'll see hundreds of videos by myself, Ron Brown, and others. Stock patterns are cyclical. Last week, I talked about how it certainly felt like we were on the way down. And as I've mentioned multiple times over the last several years, every time it feels like it's over, we take another leg up. So the question is, have we done the sell-off? And are we ready to start to move back up? And I think time will tell. There are some things to be excited about. Maybe we get a rally into the end of the year, and maybe a couple weeks into the new year. I still am concerned about the market. The Fed's going to tighten. We know they're going to stop and reduce their quantitative easing. We know inflation's a problem. But the funny thing about inflation is people have pricing power. things that you own go up in value. So perhaps, at least in the beginning of this cycle of inflation and rising rates, the market may be okay. So my guess is we go higher from here. It's a guess. It's Saturday night, midnight, going into Sunday. It's not Monday. There are no futures. And I am positioned for that, but I'll be very quick to back off and add hedges if I think the market's going to go away from me. I am at a point in my life where I want to take advantage of trending markets, whether they're upside or downside. So stage 2 greed, I want to pile on. Stage 4 fear, I want to protect my nest egg. So I have a tendency when we're going through toppy markets and sideways markets and markets that are risky to put on a lot of hedges, which means I'll give up some of the gains. Like last week, I had to sell some of my hedges early on in the week to take the full benefit. But when the market sells off, I get a lot less pain. So that's where I'm at in my life right now. So I will put on hedges. But right now, I do feel that there could be some money to be made to the long side. So where we at depends on what I'm going to do. I did start to buy stocks last week. I bought some long option positions, but I'm doing it in a somewhat cautious way. A lot of what I'm doing now is in spreads. Bull put spreads are okay. You collect the premium as long as the stock goes up. You keep the premium. I'll do some bull call spreads, giving up some of the upside, but reducing the cost of those spreads. And I'll sell out of the money calls on some of my positions like Amazon, just because the premium is still pretty fat. If we look at how the market ended Friday, you can see a pretty strong end to the market. And it's pretty much not everywhere, but it's pretty good. I mean, even if you look at healthcare, which has been a laggard, doesn't look that bad. But at worst case, it's 50-50 in all of these, and all the sectors were up 2% or more on the week. So it was a strong week. Let's take a look and think or swim at some of those major markets. And make sure I got futures. I do. Let's open it up. I like to look at the futures because it eliminates a lot of the gappiness because you're capturing more of the trading, but everybody can do what they want to do. The beauty of this business is you find what works for you, you get good at it, and you stick with it. It's been a painful year. I got to admit, this has been a tougher year than the last couple, maybe because, the stocks that I owned last year, many of which, I was up between 200 and 300% last year in the market. Those stocks have not performed as well as we've rotated into some value, and it's been a large stock market. But if you look at the S&P, what's wrong with this? This is a year, all right? And, we have gone sideways here for the last couple of weeks. But if you look at it, the high of the year occurred back November 22nd. We are just off the high of the year. We're at a John Person buy signal. And how would this not feel like a bullish chart? So lower left, upper right, just off the highs. If I had to guess, the market goes higher here, potentially threatens the all-time highs. Actually, the cash market, and this is interesting, the close was at the all-time highs. Intraday, we're still below the 47.40. We closed at 47.0475. So we're not far away. I think that's about 1%. If we look at the Nasdaq Futures, similar story, lower left, upper right. High of the year occurred November 22nd. It's not just the high of the year, just like the S&P and the Dow, the most recent highs are the all-time highs. Also in a John Person buy signal, traded down, touched the 50-day moving average and jumped. Not a surprise. So we got Friday, Thursday, Wednesday, Tuesday, Monday. So a bounce on Monday off of the 50, a strong day on Tuesday, and a good move into the week. You'll see on the expected moves how big of a move the market saw this week. Very bullish move. If we look at the Dow, let me tighten it up some. The Dow peaked a little bit earlier back in early November, and it came all the way down and tagged its 200-day moving average. And I think last week we talked that if the market was going to bounce, it was at sitting here with a bottoming tail on the 200. It was at a place we'd expect it to hold, and it did. So the market bounced. It got back above its moving averages. You're about to have We'll see if the 17 can stay above the 50 or not. But bullish or bearish, hard not to be bullish looking at this chart. If I look at the Russell 2000 using the RTI, the thing that really stands out is how is this one different than the others? And that's that the move up ended in February. And for the most part, the Russell 2000 has been in a trading range in 2021. We got faked out back here in November, and it looked like maybe we're going to break out, but we came back. We failed a retest of the upper line of the Darvas box, and we are now moving back in the middle of the range. We did not quite come down and test the bottom, but you can see the bounce here. And unlike the other averages, we're on a buy signal, but we have not retaken the 200 nor the 50 nor the 17-day simple moving average. So the Russell had a good week, just like everybody else. But right now, of the four major indexes, the Russell small stocks are lagging. The VIX got pummeled, no shocker. We talked about Friday. I believe that was Friday the 3rd. Yep. They talked about how that might be the end of the market, and we look backwards, and you see that topping tail typically after the run up, and it was, and we can see the VIX dropped from the 30 range, 31.5, and closed almost half of that at 19. So down, not half of it, but certainly down 30-40% from its highs. So that would be consistent with the market that may be strengthening. And the dollar, which on this looks like it's had a big run, it has. The dollar's sort of flagging here, and we'll see if it does a continuation to the upside. But it's in a sell signal, and as I mentioned before, a lot of the stocks that I own are more, what's the word I would use? Small stocks, and sometimes these stocks don't do well when the dollar is strong. So if we look at the weekly charts here, you can see a weekly buy on the S&P, not yet on the Nasdaq or the Dow, but you do have daily buys on those. And you can see nice run up, nice run up, nice run up. And you can see on the weekly chart really the sideways move, the false breakout, and the setting of all-time highs on the Russell. But it pull right back down, and the VIX is back down to its resting area. And where the dollar on the daily looks really strong, it's really midway between the range, a high of 103-ish, a low of 89, so that's 14, so 96 will be right in the middle, and that's kind of where it's sitting. So the dollar is way off the lows, but it's far from the highs. Now, I mentioned on the expected moves, I want to go back and look at those because I think you can see something here that's meaningful. Remember, the expected move is set by the option sellers who want to win. And so about 83% of the time when I went back and looked at a number of years, the stock will close within the upper and lower of the expected move. What determines the distance between the opening price or the closing price of the prior week and the expected move up and down, that is based upon how much the market makers are going to charge you for that straddle. So let's say this is $10. It's not, I'm just using that as a definition. You're going to pay $10 for a long call and a long put at the money. Now, as long as the stock price does not go above the green or below the red, the market maker makes money. Once you break above the green and the red, that position turns profitable. So the smartest money in the world are the option sellers. So if they're selling you something, they're expecting it to stay within that range. If they think it's a more volatile week, then you're going to see a larger range. And it looks like they're expecting a less volatile week this week. Well, let's look at what happened last week. The white bar is where the market closed the prior week. And here's the E-minis. You can see Monday and Tuesday were super strong days. Sort of a pause on Wednesday. Inside bar down perhaps on Thursday, and a bullish engulfing pattern on Friday. We closed within the range, but that's more bullish than bearish. And if you were long the S&P, you were happy because you were above the prior week close every point of the market this past week. If we look at the Nasdaq, you'll start to see an aberration. So a little bit move on Monday, a giant move Tuesday, taking out the expected move, and then really going nowhere and closing right about where it closed on Tuesday. So that's a very strong week. So the Nasdaq breaking through the expected move, closing above it. So that was an impressive move in itself. If we look at the Dow Futures, just like the Nasdaq, Monday and Tuesday were strong. Wednesday and Thursday really were pauses. And then we had here we go, another big update on Friday, again closing well outside the expected move. So the market makers took it on the chin on both the NASDAQ and the Dow futures. If we look at the Russell futures, this is kind of what I expected to see on the NASDAQ and on the Dow, and we didn't, which is once it breaks out, I look for a reversal. Now, I don't sell this candle where my highlight is. If I take out the low of this candle, then I get interested in going in the direction um, back into the channel. And you could see that would have been a good trade on the Russell. So the Russell looks like it did finish in the upper part of its expected move range, but it gave up some of its gains on Friday, probably related to the dollar and rates going up because of the CPI. The VIX, major move. Broke down on Tuesday below the expected move and just continued to drop, just showing you that some people think some of the fear has come out of the market, perhaps the volatility, and the dollar really was massively unchanged on the week, closing right below where it closed the prior week. So an impressive expected move week, especially when you look at what happened on the NASDAQ, the Dow, the Russell, which came back in, and the VIX just getting hammered, which, if you're bullish, is a very positive thing. You want to see the VIX down. So we keep going through my charts. I like to look at what happened. And you know what? I goofed. I didn't check this right. I would say rates rose on high CPI. So I like to, it's silly. You're thinking, why would I bother changing it? Because I save these. And you could see both the 10-year and the 30-year rates. It's hard to see, but they moved up this week. No surprise, but they also didn't move up and challenge the recent highs, and they're still very low in the pattern, and that might be why the stock market held up surprisingly well. AD lines turned up on both small stocks and high stocks. They're both below their highs, but you can see that the large stocks, as represented by the Russell 1000 and the IWB, both the AD line in white and the index are much closer to their prior highs than the AD line in white and the index in green on the small stocks. If I look at the NYSE, you can see it turned up. You can see the TLT turned down. And these other lines here represent the major market ETFs, which turned up with the AD line. So that's a positive thing with some breadth improving on a strong week in the market. If we look at stocks above the 200, stocks above the 40, also improved. And if we look at the 3-month new high, new low, we talked about last week that sometimes when it gets to this level, it can reverse. Reversals usually associated with a recovery in the market, and we had a pretty massive reversal. Those that use real-time tools like Q Edge could actually see that happening in front of your very eyes when you looked at the buckets, perhaps more than this. And I follow this in real time as well. The Mcclellan Oscillator, it had tagged the same area. I thought this was fascinating, and reversed the same area as we saw back in March of 2020, and it rapidly moved up. It'd be interesting going back in the market and looking at this rate of change in the Mcclellan Oscillator in this short period of time and looking back in the historical market and understanding what does that massive breadth spike thrust actually mean. Interestingly, the summation index changed minimally. If I look at the weekly, again, we came and tagged an area that we thought would be a likely area of reversal. You'll also notice we continue to go higher there, and we still have not taken out prior highs on either the oscillator or the summation index, so we've been dealing with some divergences there forever. The buckets, 50-50 pretty much. Half the stocks thereabouts are above their midline, their Bollinger Bands, half are below. And I look for extremes over on the right or the left demonstrating stocks below or above their Bollinger Bands. We don't see them. This market has really come back to a more neutral character. From a Hindenburg omen perspective, the last omen on the NASDAQ was the 23rd. On the NYSE, also, excuse me, on the NYSE was the 23rd, the Nasdaq was the 23rd. And if we look at the number of new highs and new lows, you're starting to see on the NYSE more and more new highs and the disappearance of new lows. And on the NASDAQ, we still see some new lows. The NASDAQ clearly, despite having a positive week, there's still some weakness when you think about some of the small cap stocks that might be in the NASDAQ. If we look at market tone, you certainly get the hint here at the Woody indicator down here that we've got more green and no red. The market's clearly suggesting some increasing strength. Even if you don't see it today in your portfolio, I think the market has improved some. And as I looked at stocks this week, on my bottoms up, where I look at a large number of stocks, clearly I saw evidence of improving market. Now, if you look at the performance by ERG, everything's positive. So when you see this line across at 3%, you know it was a strong week in the market. Now, I throw out the tails because if you look at the number of stocks at the tail and at the head, they don't count. And, I don't know if this spike is meaningful. It's still very few stocks. But there's no question that there's a hint that as you went up in ERG, which is a combination of earnings per share, relative strength, and group rank, that you seem to improve. But I'll just say it was a strong week. It was good for growth. And you could see percentage move versus the various deciles of these measurements. Now, it's funny because I had hedges. If I look at what I started the week with, I was up, but I was underperformed the market. But this is really not necessarily reflective because I sold many of those hedges, some of the contra ETFs, and I went extra long. The keepers, which is something we put together in October as a signal of the market, did roll over, but it had a nice recovery this week. It was up 3%. The S&P was up 2.6. In orange, you can see a number of the IBD indexes. So growth was back. Sector strength, almost everything is green. So that also is very discretionary, is the one thing lagging. Now this represents the SP 500 sectors, and I'm looking at the Woody indicator. Here I'm looking within the Q Edge tool at the S&P 1500. So here's the big difference that a month ago, everything was weak. And over the past month, it's been a weak market with 91% of the sectors down, 77% of industry groups down, and 2/3 of stocks down. But something happened over the last 5 days. We flipped the narrative. Now, on Thursday, we had some weakness, and on Friday, we turned around. And if I look at the sector performance, for the 5 days, we were up in all 11. You compare that to a month performance, we were down on 10 out of 11. If I look at one day, we were up 8 out of 11, but over 2 days, we were down 9 out of 11. So we're still going back and forth, but clearly this market has improved, and maybe it's going to continue to get out of the doldrums. Other evidence of improvement, we continue to increase. This is the real-time buckets, 45%. And a week ago, I was looking at much higher numbers here on the red. So this market has definitely improved. And perhaps it's improved more than we actually realize if you're a high growth stock investor, because small cap growth may have lagged some. If we look at what are the leading sectors in the S&P 1500, energy, staples, and utilities, the fact that staples and utilities are up near the top is bothersome because those are defensive. I saw a number of staples and defensive plays, things that you might want to buy in a bear market, looked interesting. Energy is bounces, it's the leader, it's the lagger, it's the leader, it's leading as oil prices started to firm as the Omicron concerns seem to abate. If we look at the top industry groups in the top three sectors, you could see oil gas drillers come to the top. And at 147 for the last 2 weeks, they have represented the number one industry group. Now, I like to look at the stocks in the top industry groups. These were the list. And then I look at the crown candidates from Sagar, and you could see we have a bunch of oil services, either drillers or service companies, refiners, showing some strength there. I thought that of all of these, I think pump is the one I like the best. And we may look at some of those as we go forward. Now, again, I'm the guy that has over the last 20 years have bought every program on the market. There's some that I still use. There are many that I don't. This is a program that I didn't use as much as I could have, which is Metastock. And frankly, I don't need to because everything in Metastock I can reproduce in Hgsi. And then Sager did all these Q tools and some things with fire. And so I love Sager's tools, and I can look at the market in this one sheet, the S&P 1500, the Dow, Nasdaq 100, the SP 500. I can do a combined market breadth. And down here, I got I got 6 different indexes, and I look for the red dots, which are distribution and accumulation. Um, and when I look at this, the markets have clearly improved over the last couple of days. We got rid of the large number of red dots that were piling up here. We bounced off of the 3-month new high, new low, got to extremes and bounced. The markets have improved. Now, whether the markets will continue to go higher into year end, which I think could happen, or they start to sell off again, will be driven by the news. If there's a new variant, if Omicron seems to be more virulent or bad for you, then people let you know. There are many reasons that the market could turn. But I think we're in a very, not think, I know we're in a very strong seasonality, and hopefully, you know what, we put my money where my mouth is. So for those who have known me, know that I'm a big seasonality fan. And I own every seasonality product in the market, and I continue to play. But you know what? There's a simple one. It's built into EdgeRater. EdgeRater costs less than most other seasonality programs, and seasonality is maybe 1% of what the product offers. So what I did here is I ran seasonality, and you can basically define your list. So I looked at stocks above $2.50 or $2 and 250,000 shares. So it's a relatively large list. And I asked the question, what is seasonality in 2 weeks, 1 month, 2 months, 3 months, 4 months, 5, and 6? And typically, because I am not a day trader, I'm not a fast trader, I'm a slow guy, I like to look at a month. So I ranked them here by number of up years. And what I can do in EdgeRater is I can say, show me all the stocks with 8 or more years positive and 3 or less negative. So at least at the worst case, it's 8 out of 11. And these are some of the things that came to the top. And I think the thing that really I thought was interesting, especially with the inflation data, is junior gold miners have been up over the next 1 month, 8 out of 8 years, so 100% of the time, for an average return of 20%. Well, that's kind of interesting. And you can notice here with the First Majestic Silver up 80% of the time, average 13%. I score these, which is a multiplication of their average return and how many years they win. And when I get double digits, I find stocks that may actually perform well. If I look to the downside, I can see there's very few stocks. And if I look at the top 3, this is going short junior gold, short gold, long natural gas, all were negative plays. So Semiconductor bear is another negative play. China bear, small cap bear, financial bear, tech bear, ultra pro shorts of the Qs. When I see bear things here, when bear things do bad, that's bullish. So in reality, almost every one of these are bearish contra ETFs. And if contra ETFs are in bad seasonality, that's good for the market. So I think this market is telling me, this sheet here, that this is a time where seasonality is going to be our friend, and it's something that I'm going to be watching, and it is impacted on my thoughts about this market. So back to the spreadsheet. So the canaries, this is Ian, I think, was one of the ones that really pushed this. This is an extended FANG. And just like last week, I'm saying the same thing. Last week, we were bouncing off the 50-day moving average. And oh my goodness. Sometimes I do this so fast so I can get this done before I go to sleep. I forget to change things. So it pulled back twice to the 50-day moving average and bounced 1, 2, 3, 4, 5. So the last time, a week ago, it bounced, it failed at the 17. back to the 50 and bounce? Will we make it above the 17, or are we in a new downtrend? So we'll have to see. But right now, I'll tell you the uptrend, in my opinion, is still intact because the 17 is above the 50 is above the 100, and the 100 is above the 200. So be nice to bounce off here and come back and take out these prior areas here of resistance. And I think the canaries, being large cap growth, might benefit with both the seasonality and um, growth in large stocks. Now, in fact, one of the things I didn't point out on this Metastock form that Sager put out in blue, small cap versus large cap. Well, you could see right here, small caps in the toilet. And here is looking at growth versus value. And it's been all over the place. And maybe growth ticked up a little bit this week. So I learned a lot from this. And again, do you need to own all these tools? Absolutely not. You can probably reproduce many of those things in HGSI. I'm just not as good as Ron. I'm not as good as putting together those charts. And so maybe I lazily use other programs where it's done for me. But HGSI, obviously a great program. I use it every day and every time in this presentation. So canaries are bouncing. The keepers, this was that artificial index. I'm just looking at AMD. Let's look at the keepers real quickly. So if I go here and I change this to the keepers, where are they? They're up here, I think. And I don't want to look at AMD yet. Let's look at the Keepers Index and see what the Keepers Index did. And you can see the Keepers Index is broken down. So why did we put the Keepers Index? Because we knew when this rolled over, remember we put it together in here of market leaders, and knowing that when it rolled over, it was time to start lightening up. And it was interesting, the same time we got the Hindenburg Omens, the Keepers rolled over. They broke through the 50. They failed here. That tells me it's a broken market. Now, have we dropped enough that the market's going to recover? Time will tell. But the keepers did their job, which is gave us a clue that the market in general was going to roll over. Know your news and earnings. On the left, we got some PPI on Tuesday, so that could be interesting. Retail sales, business inventories, a Federal Reserve announcement, and a press conference. So by definition, this is a busy week and a high risk week where we wait to understand what the Fed is saying now about rate hikes, inflation, and easing. Jobless claims on Thursday, building permits Friday's an easy day, and earnings have lightened up. We've got some Lennar, already had some good housing earnings come out, so we'll see where we go with that. As I say in the lower right-hand corner, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled, and I'm so happy I don't see any of my holdings here that are coming up this week because, market thoughts, S&P was up 3.8. You can read it yourself. You can see all the indexes were up big. All the sectors were up. I saw much of the rally occur early on the COVID news. Then that hot CPI, which I thought would be bad, was actually good. And perhaps, maybe it's comments the Fed made. Maybe it's feeling that we can withstand some rate increases with such a strong economy. That in even treasury yields, even though they rose on the week, it was a muted response considering a CPI that was the biggest one since the 80s. High growth rallied with the markets. We enter a strong seasonal period, as I just show you. I lightened up my hedges, added to longs, and I think this is when I will shine, which is when stock pickers do well. So let's quickly take a look at the markets and a few stocks, and then I'm going to go to sleep, and we'll see if this posts tonight or tomorrow. So let's take a look at NHGSI. We'll start with the SP 500. Shocker, you could see the bullish move on the weekly. If I look at the daily, we bounced off the 50. What I like to see, a mobile breakout from a squeeze, a Eureka telling me the market is having a follow-through day to the upside. You've got kahunas, lagged a few days for the bongo to turn. That's a very bullish picture, and my expectation is we'll take out prior highs. We'll see how far we can go. Maybe we get that rally into year end. What do I like? I like the fact that we got a new weekly bongo. That's green. There's really very few people that are looking to sell above this price, so I don't have a lot of overhead supply. Those three kahunas in 4 days is also very bullish, and that Eureka is sort of our signal of time to go long in the market. So to me, very, very interesting day. You can see the last time we had that Eureka, the market went sideways for a while before it took off, and this Eureka occurred as the market was already starting to move up. The Eureka is something that Ian came up with. The darker color is a stronger signal. Now, I know my friend Kathy last week said she didn't see a Eureka or something when I made a comment to her. Remember, the Eurekas are calculated. Oh, that's the wrong one I hit. I wanted to hit this one. The Eurekas are calculated on either the Nasdaq or the Nysc. So what I do is I have one set that's done on the Nysc, and then the other set, which is done on the Nasdaq. So I'll look and see, and I don't know what the difference is, if it means anything, if it's one or the other, but I don't want to miss one, so I look at both of them. Just like on the Hindenburg Omen I showed you a few weeks ago, that I do one signal of the all NYSE and one of the bar chart market indexes, and I uncheck smaller these numbers is greater than 79. So again, if your signals look different than mine, it could be because you've got that checked off or you don't have both of the sources put in there. So S&P looks strong. We talked about that before. If we look at the Dow Jones Industrial Average, it's right probably in front of my face. Here it is. Similar story, bounced off the 200, which was worse. You look at the weekly, also strong. Sideways here, look at that weekly move. Dow looks strong. If I had to bet higher or lower, I think the Dow goes higher. If I look at the Russell, this is different than the others. And we'll look at the IWM as a measurement of the Russell. The Russell is below a Chandler stop. It's below the 17. It's below the 50 and 200. And if I'm not as convinced about the Russell, I think the small stocks still have weakness. And if I look at the weekly and the Darvis box, it's it's in the middle of the box. It could go either way. This to me was very disappointing. I was so excited when we broke above what had been resistance all the way back since February, and within 2 weeks we're back in the box. So the Russell clearly looks weaker, small stocks lagging. And if I go look at the Nasdaq, the technology laden index, you could see it's actually in between, I think, the S&P Dow strength and the IWM small stock weakness. But you look at this weekly reversal here, you're above the 50 and you're above the 200. I'm less convinced on the NASDAQ. It's got a kahuna to the downside. The weekly bongo's still red. So this is in the middle. Strength in the Dow and the S&P. Middle is NASDAQ. Russell, the laggard. All of them were up on the week. Let's just look at the Nasdaq 100 and see if that looks any different. And it does. Notice the Nasdaq 100 actually is above the 17 and had a mobile breakout from the squeeze and a person buy signal. So the larger caps of the Nasdaq, keeping in vogue with large better than small, are actually looking okay. Now, if I want to look at some of the things that make this up, I like to look at Biotech. I like to look at FANG, which we already, here's a pure FANG. And it's hard to get excited here. So that extended FANG, those canaries actually looking better. Amazon's not helping this. Amazon is a big stock and it's a laggard right now. Although on the weekly, the FANG did okay. If we look at the IBD 50, right here, you can see that small cap growth sort of doing nothing. In fact, it's almost like it's gone sideways since February, just like the Russell. So for those that have a portfolio heavy laden with IBD stocks, you might not have believed it was a very strong week, and you're probably lagging behind the big indexes. Biotech, oh, man, has that been ugly. Biotech is just doing horrible. I think the biotech story is here was called Moderna, Novavax, BioNTech. And now this is called, we're doing okay with COVID, and maybe they're not as important anymore. They're components of IBB, LABU. They're not the same, and you should know the components of the ETF, especially in biotech, because that's why they may not behave the same. Biotechs look like crap, and if anything, it's in a downtrend. I wouldn't be touching it, which means maybe it's time to start looking at some to nibble on. But biotech is super, super weak. I wouldn't be buying that ETF without some significant improvement. Another thing I like to look here is the Philadelphia Semiconductor, and this is strong, totally opposite of biotech. Closing near all-time highs. Look at the strong weekly, although it did not end the week as well as it began the week. And the other thing I like, let's look at ARK, the innovation, ARKK. Again, small cap growth is bad, and Kathy Wood is being challenged here. ARK Innovation is lagging. So not all parts of the market are behaving the same. Large cap winning, growth is okay, but just not small cap growth. Now, I also like to look at things like the dollar. Now, we looked at it before, so I'm not going to spend as much time on it, but the bullish dollar, it's gone sideways. It's got a sell signal. It's below the PSAR. Is the dollar done? I would love it because it means my smaller cap stocks will have a chance of rallying. The VIX, we know, came back down. And what about the gold? Is gold ready to run? Now, it's interesting because seasonality right now is super strong for gold. Yet, what is gold doing here? Absolutely nothing. So I'm not buying it because of seasonality. I'm watching it closely. But until gold can get above those moving averages here, I'm not touching gold. Now, maybe it's about gold miners and not gold. So we got to look for the VanEck Gold Miners ETF. And now that looks ugly too. So I'm aware that seasonality favors gold right now. Probably not going to be chasing after gold. Now, if I go to 7 industry groups, warehouse view, and I look at 2-day force, I can see that we've gone up to 33, so a big jump in the positive groups. Look at 2-day down to 5, airlines, casinos, steel, IT, and communications. Here's the funny thing. Those were weak on Friday. Look at the strength of this group. Casinos up 13% on the week, steel 6%, 8.22, IT services 6.76. So clearly there was some profit taking in those groups. Now let's look at some of the top groups here. Make sure we're ranked on the raw. Automobiles. Well, it used to be Tesla. Now it's Ford and GM. Obviously, Tesla has had a big run. Ford, if you look at the, and I own Ford for transparency. Ford's, if you look at the fundamentals, the earnings per share growth don't look so good. But if you look at that, I saw a Mustang. I parked next to one. I was just in awe of what they're doing. You look at companies like Ford with a multiple of 11 who are going to electrify their vehicles. They've got the Mustang, they got the Lightning, they had to cut off pre-orders at 200,000. Was in a high base here, so it's a risky base. I'd rather be buying it off the base down here, but it broke out on Friday. Mobile breakout from a squeeze, a John Person buy signal, a kahuna. It's a nice looking chart. It's extended and you've got higher risk as you're approaching the high jump bar. I have a position here, and I'm impressed with that. GM also had a great day. Again, and I think about GM, I've got a Hummer on order. I love cars, all right? So I was talking with some friends. I've got a Hummer on order. I've got a Lucid Air on order. I've got one of the new EQS Mercedes on order. And I got one other one, mental block. Taycan SUV is the next. So I've got a bunch of, because you don't know when you're going to get these cars. And, the first one, and I got one of the F-150s, Lightnings. When they hit, I'll pick which one to buy. I'm hoping I get the Mercedes first. But as the other auto manufacturers are going to start to bring these to market, all right, and this is a beautiful move, sort of a cup, a handle, and a breakout, mobile breakout, pocket pivot, kahuna, new John Person buy signal. It makes money, multiples 8. Then you look at Tesla. Love Tesla. I had one. It was fine, all that. I had no issues with it. But it has a multiple of 329. Now you look at the growth rate in earnings. That's awesome, all right? Okay, and you look at the last 4 quarters of revenue, 10, 20, 32, 14, 46 billion. And I go back to Ford. and it's 4 times that size or 3 times that size, and it gets a multiple of 11. I used to think Tesla was expensive. I'm starting to think that maybe Ford and GM are just cheap. So I own Ford. I may add to it. Home builders. And this is interesting. If rates are going up, why are home builders doing well? D.H. Horton breaking out. I don't know if it's all-time highs, but I got a feeling it is. New highs on D.H. Horton. You can see good earnings per share growth, still single-digit multiples. D.R. Horton. Lennar looks very similar. Toll Brothers looks similar. Pulte, not quite as extended, looks good. This index has done great. You could also own things like the XHB. Okay, look at it on the weekly chart. ITB is another one, and then NAIL is another. So if you don't want to take single stock risk, if you think it's getting late in this run, there are a number of ETFs that represent this group that you could be buying. Exploration and production, I said energy was strong. Oil prices are up. And just a couple here, I mean, you're going to see stocks that have pulled back, and we might be looking for some opportunities. Southwestern is a messy chart, but it's starting to break out here. It's got great earnings per share growth, under demand. Again, is this a clean chart? It's an ugly, horrible chart. Um, it's just finding the one you like. Apache's pullback. Conoco's going sideways. A break above the Chandelier stop would be interesting. Pays a dividend. So these are up there, but they've all been in pullbacks, and it was hard for me to find one that I loved. Biofuels are all below the index. There's some changes going on with some of the tax breaks or something on the biofuels that look kind of bearish this week. So I'm surprised that this even made the list. Infrastructure software. Oracle, what a star. Bible gap up. Their rules how to manage it. Probably too far for me to chase. But the only thing I like about Oracle stock chart is the baby daddy for this lovely little girl, my grandchild number one. He works for Oracle. So hopefully he's got lots of stock because my granddaughter needs to be spoiled. Microsoft, I added to my position on Friday. It pulled back, had a new breakout, a new John Person buy, mobile breakout from a squeeze at a kahuna. Certainly doing well. Fortinet, it broke out above the 50 with a kahuna and mobile breakout. Doesn't look too bad as well. Security stocks had pulled back. Are they starting to move again? Here's Palo Alto. Be interesting to see. Mass merchants, Costco, what a beast. Maybe a time you can buy Costco again. Pullback, breakout on Friday, Bible gap up, mobile breakout from a squeeze. New person buy, pocket pivot kahuna. Good earnings per share growth. Teeny weeny dividend, too bad. Look at the revenue bump. Wow. 53 in the quarter and 20 to 62. Okay. That's impressive. There's a reason why Costco looks so good. I think Costco looks great here. Yeah, it would have looked better here. Boy, would it have looked better here. But I think it's giving you a chance to get in right here. Walmart, doesn't look like Costco, does it? I'm not interested. Dollar Tree, I don't shop there. The pattern doesn't look too bad. Has had a nice run up. BJ's, not as good as Costco. All right. I'm going quickly now. Large pharma, Pfizer, I love. Pfizer pulled back. And maybe Pfizer is going to give you a shot to get in. I'd rather buy it down here than it up at the top. But I got to see some momentum that it's going to go higher. I might, if I was interested in it, I am. I might have a buy stop somewhat above the high of the day on Friday. You can see kind of a reversal candle on the weekly with a bottoming tail. You got to love Pfizer because of its COVID story. It's a real pharma company who's been given a ton of cash injection because of the success of its vaccine. And Pfizer's a smart company. They're going to put that to work in R&D. They also separate some of the financials so that when the COVID goes away, it's not going to look like the earnings are doing nothing. Pfizer is one of my favorites. AbbVie, as I said I'm at American Society of Hematology meetings this weekend. As I said to somebody from AbbVie, you're like you're a biotech, or you want to be a biotech, but you're like Big Pharma with a dividend. I liked AbbVie 2 weeks ago. I liked AbbVie a week ago, and I still like AbbVie, although it's starting to run. It's got earnings per share growth, and it pays a 4% dividend. The rest of these, Sanofi, no, J&J, maybe these are going to be good, but they're all down in their pattern. My preference in this group is Pfizer and AbbVie. Group number 8, payment and payment processing. Are these back? These have been hurt this year. You can see the messiness here. Big day on bottom line ePay on Friday. I don't know anything about this. Bible gap up. The problem is the bottom is at 48, the top is at 53, so you're 10% below the close. That's a little bit too much for me to give room. ADP, this is a nice looking pattern, nice uptrend, pull back to the 17, mobile breakout from a squeeze and a kahuna. I would like this pattern much more. Paychecks similar, pull back to the 50, that looks interesting. And again, the way I buy, I'd be looking for a move above the prior high, at least the high of that day. And Broadridge actually has something I really like on it, and it's broken above its chandelier stop and the PSAR. Had a John Person buy signal and a kahuna come in at the same time. That's also looks interesting. So there's a lot of things here that, there's a lot of strong stocks. If you think back over the last couple of weeks, that's not what we saw. CVS broke out. Time to buy it was here when it took out its chandelier stop. Kahunas, pocket pivots, new person buy signal, squeeze. Can you buy it here? It's too far gone for my taste. It's getting close up here to the high jump, but CVS looks great. Kroger's a little bit messier. Walgreens does not look like CVS, does it? That's interesting. And then the 10th group, cruise lines. Obviously, you buy at your own risk. At some point, these things are going to recover and go back up to prior numbers. But they've had a lot of fits and starts. Carnival, look at the demand, 4.4. So lots of demand. But look at how horrible the fundamentals are, and look where it's sitting in its pattern. It probably had a huge volume day. It had 33 million shares on Friday. That's a lot of volume. But, it's down in its pattern. Norwegian down in its pattern, Royal Caribbean down in its pattern. I don't have the patience to buy something like that. I could tell you one thing that was different this week than from the last couple of weeks was not only did I see a number of attractive stocks in viable positions, I had a really hard time finding shorts. So, at the risk of showing you too much, and you're thinking, what else is new? Let's very quickly look at my buy watch and see what one of my favorite stocks might be to look at for this week. So 39 stocks looked interesting to me, many of which we've already seen in just the top 10 groups. I'm going to put this filter on and I'm going to rank them by industry groups. So Ford and GM I liked a lot. I am interested perhaps in adding to Ford or getting a position in GM. And you can look down here, home builders, we saw them, the Horton, Lennar, and Toll Brothers. Microsoft looks great. When I put utilities on my list, it doesn't say great things about the market. The same thing when I put consumer staples. And I think I got Clorox on it somewhere in here. Yep. Household products. So let's look at Clorox. Now, that's not a good looking stock. It's not a growth stock. But why do I have Clorox? Because if this market goes into a bear, if this market continues to punish growth, it's got a nice dividend. It started moving up. This is one, it's a pullback here, but it's off the low. 1, 2, 3, 4. It's like 6 or 7 weeks off the low. And if you think about how the market's been punishing growth of late, It's not growth. Believe me, I get it. It's defensive. Fact that staples were the #2 group this week tells me don't ignore the word defense. All right, so I'm not saying to run out and buy it, but it tells me defensive is interesting. Rather than going out and buying the cruise companies, as I'm sitting here in a Marriott, JW Marriott in Atlanta, what about Marriott Hotels? So another way of playing the travel besides airlines and besides cruise ships, maybe we're better off playing hotels. The hotels seems to be fuller than I've seen any hotels of late. And a lot of these companies don't actually own the buildings, they manage them. And so you look at the debt that's drowning the airlines and drowning the cruise ships. Maybe you can get the benefit of the back to travel by owning a Marriott hotel, for example. Look at the earnings per share, massive recovery here. A 5.3 billion quarter in December here, which is probably a high quarter because of the travel, dropped down to as low as 1.46, and now it's back up to 3.95 and continuing to grow. So I like Marriott, and I'm thinking of taking that being my position. Healthcare looked interesting. Anthem pulled back to the 50 in a breakout here, took out the chandelier stop, had a kahuna. I like that pattern. And one that I've liked for some time is Centene. And I believe earnings came out on Centene, and it's outperforming, broke out here as well. So there's a wide range. And then, I like Nutrien, and it just looked like it's pulled back to the 50. I had it earlier. Sideways move, had a mobile breakout from the squeeze, weekly bongo turned green, a pocket pivot. I like to see it get above the chandelier stop, but look at the strength on the weekly. So there are a lot of stocks here that look interesting. Not all of them are at great buy points. Bath and Body Works, I'll have to ask my wife about this, but why did I pick this? Well, I look on the right. Is this a leader? Absolutely. And then I look over here and I see a pullback, sideways movement in here. I had a mobile breakout from a squeeze. It's in a person buy, had a kahuna, and this is the chandelier stop. I could set a buy stop above that, and that might be a trade that I'm going to look at this week. Anything else that jumped out? Again, if I want to find chart patterns that I like, here's a strong uptrend on the weekly. So I want to buy that because of its longer term trend. I want to buy it on a pullback to the 50 and then a breakout. And we got it. Took out the chandelier stop. Still got to clear the PSAR. I could put a buy stop. This is Newmark Group. Put a buy stop just above the PSAR. I've got a natural stop here below the 50, which is about the same low of the lowest low of the last 4 bars. That's one that I liked as well. So you can take a picture of this if you want. I don't guarantee anything. Mondelez, another consumer staple play, maybe a better looking chart than Clorox. Sideways move, took off on Friday, took out a chandelier stop, weekly bongo, mobile breakout, person buy, kahuna, 2.1% dividend. So I'm looking at some evidence, right? If I go into my TradeStation scanner, just for grins, and of course I didn't load it yet, so let me pull it up. Boom. I want this one. So first thing I noticed when I started preparing for this work is that I have, if I look at go with flow longs, which is a trend change indicator from Sagar, and I look at all stocks and I limit 2.5 and 250,000, 73 new longs, and as you can see, there's still a lot of negativity in the market, 145. If I look at the John Person buy signals, I had 49, and new sell signals, I had a lot more. So there's negativity in this market. All right. So I'm feeling a little bit bullish here, but I don't want to ignore the fact that there's still negativity in this market. When I look at the major market ETFs, bounced off support on the spiders, on the Qs, on the diamonds, and I got to believe these things are going higher. This guy's different, and this is, I think, what's, many of us that do small cap growth, we need the IWM to join the group. Right now, it's not joined. So on that note, I hope you have a great trading week. We're getting into the holiday season. I don't know if I'm going to do this every week. Yes, I say that all the time, and I still do it. Why? Because I enjoy doing it, and I do it anyways as part of my routine. Trade safe, be safe, travel safe, and we'll talk to you next time. Have a great week, everybody. Go Bulls, and go Blue. College football playoffs. Bye.